Welcome to this explainer, focused learners. I'm putting on my professional commodities analyst hat today because we've got to talk about what is honestly the single most important lesson in your entire trading journey. Look, we've gone over a ton of frameworks, right? Strategies, deep dives into the commitments of traders or COT report. But today is all about the ultimate fail-safe. Because here's the reality. The biggest difference between a consistently profitable COT trader and someone who eventually just blows up their account isn't about knowing when to trade. It's knowing exactly when to ignore literally every single COT signal you've ever learned. So here is our diagnostic triage structure for today. First, we'll look at when the COT lies to us, then identify the 5 specific failure regimes and walk through a real-world case study of the 2020 shock. After that, I'm going to hand you the COT validity checklist, break down how to score it and adjust your sizing, and finally wrap up with your new weekly audit process.
Section 1. When the COT lies.
Okay, let's just get right into it. We all know that awful feeling of losing on what looks like a totally perfect setup, right? The managed money extremes are perfectly aligned, the seasonal patterns look flawless, but then bam, the market just runs you right over. Why does that actually happen? Well, take a look at this quote from our source material. Any predictive model works only within the regime for which it was calibrated. Now, I know that's a tough pill to swallow for a trader's ego, but to survive in commodities, you have to accept that when the underlying regime fundamentally changes, your model just has to be suspended. It's not that your edge is gone forever, it's just, well, temporarily vanished. And here is the uncomfortable truth behind all of this. The COT report, it's really just a paper representation of positioning in the U.S. regulated futures market. It's paper. It doesn't, and honestly, it literally can't capture the whole shebang. When massive, dominant external forces take the wheel, think enormous central bank buying or a crazy surge in physical demand, the COT suddenly becomes a highly misleading indicator. If you just blindly follow it during those periods, it will systematically destroy your capital. No joke.
Section 2. The 5 failure regimes.
So how do we actually spot these dangerous periods? We diagnose the market by looking out for 5 very specific regimes where our normal COT signals systematically fail. First up, we've got sovereign overwhelm. That's when massive central bank buying completely dwarfs COMEX paper positioning. It's like bringing a water gun to an artillery fight. Second is physical dislocation. This is when the physical market completely decouples from the paper market, usually because of a delivery squeeze or some major logistical nightmare. Third, we have structural evolution. That happens when a flood of new participants or products enters the market and completely changes what the historical data even means. Fourth is an event-driven change. Think of a catalytic macro shock, like a global pandemic or a war that resets the board instantly. And finally, number 5, the echo bubble. This is where pure narrative drives the price, like social media hype or massive ETF flows, without any real actual changes in futures positioning. In any of these 5 regimes, historical paper positioning is absolutely irrelevant.
Section 3. Case study. 2020 shock. To see exactly what an event-driven change and a physical dislocation look like in the real world, let's just trace this timeline from 2020. Okay, so in February 2020, everything was normal. Paper pricing was standard and COT positioning looked totally typical. Then, boom, early March hits. We get an event-driven change with the COVID-19 pandemic shocking global markets. Almost overnight, all that pre-pandemic COT data became completely obsolete. Fast forward to late March, and we're seeing a massive physical dislocation. The COMEX London spread completely blows out to over $50. By April, an absolutely chaotic delivery squeeze whipsaws the market. Now, the COT report at the time was screaming extreme overbought conditions, so stubborn traders just kept shorting. And man, did they get heavily penalized for it. Why? Because the price was being driven by desperate physical urgency, not paper speculation.
Section 4, the COT validity checklist.
Right, so the million-dollar question: how do we make sure we aren't the trader who gets run over? I highly recommend you literally take a screenshot of this CVC quick reference card right now. Keep it handy on your desk. It outlines 8 highly specific warning flags. Ask yourself, are central banks buying over 800 tons a year? Is COMEX registered inventory sitting below 5 million ounces? Is the EFP spread wider than $15? Have we had a major macro shock in the last 4 weeks? Has the CAPI shifted by more than 40 points? Is the price trending hard while managed money net long is just sitting completely flat? Has open interest blown up by over 50% in the last 3 years? And finally, is your personal 10-trade win rate hovering below 40%? If you are nodding yes to these flags, your market regime is currently failing.
Section 5. Scoring and sizing adjustments. Now that we've got our qualitative warning flags, we need to translate them into hard, undeniable math. The math here is incredibly simple, but trust me, it's highly effective. There's a maximum of 8 possible points on this COT validity score, or CVS scale. Each yes to a warning flag on that checklist you just screenshot, that equals exactly 1 point. It's a strict 0 to 8 scale, giving you an immediate, objective diagnostic on the health of your trading environment. And this table shows you exactly how to translate that score into immediate action. If your score is a 0 or a 1, great. You have full validity. You can trade normally. If it creeps up to a 2 or a 3, you need to start exercising caution. Cut your position size by 50%. Now, if you hit a 4 or a 5, you are looking at severe distortion. You should take absolutely no new COT-based positions and manage your existing ones with super wide stops. And please listen to me carefully here. If your score hits a 6, 7, or 8, the COT is officially invalid. You must close all COT-based positions within 48 hours and go straight to cash. No exceptions. Basically, anytime your score hits a 4 or higher, you are entering capital preservation mode. What does that actually mean? It's a state where your one and only objective is protecting your capital, period. This requires supreme discipline, folks. Do not be that trader who sits there stubbornly holding positions through a massive regime shift, praying the market will eventually come back. It might not come back for months, and your account will literally bleed out while you wait.
Section 6. Your weekly audit process.
Okay, to make sure you actually follow this discipline, you need a system. I'm going to slow down the pacing right here because this is basically your institutional grade checklist. Every single Friday, before you even glance at a chart, before you check any seasonal patterns, you have to execute this 3-step weekly routine order. Step 1, run the checklist and compute your CVS score. Step 2, if that score is 4 or higher, you stop immediately. No further analysis is needed. You are in capital preservation mode. Step 3, only if that score is a 3 or lower do you proceed with your normal COT analysis, making sure to adjust your position sizes based on that table we just reviewed.
So why are we so strict about making this a rigid Friday routine? Simply because of the massive psychological challenge of admitting your beloved model is broken. When the COT index flashes a screaming extreme, your ego is going to yell, "I can't miss this setup." And we all know that voice is the absolute fastest way to blow up an account. The difference between survival and total ruin is pre-commitment versus emotional trading. By committing to these hard rules on a Friday, when you're cold, calm, and calculating, you're executing a pre-made risk rule. You're completely sidestepping the trap of making an emotional, panicked decision in the heat of a market squeeze.
But hey, remember, this signal isn't going to be broken forever. Regimes do normalize eventually. But you can't just jump back in blindly when you feel like it. You have to use this strict waiting protocol. Here are your reentry criteria. You need to see a CVS score of 2 or less for 2 consecutive weeks. Cross-asset positioning, or CAPI, must have stabilized. At least one COT signal needs to be actively confirmed by actual price action. And finally, your trailing 10 trade win rate needs to rise back above 50%. When, and only when, you see all 4 of these criteria met, you can safely resume trading at half size for that first month back. Look, the trader who knows when not to trade is ultimately miles ahead of the trader who only knows how to trade. The ability to spot your blind spots and literally stop trading is the true hallmark of consistent profitability in commodities. So I'm going to leave you with this final provocative thought. When your perfectly calibrated setup flashes a screaming buy or sell right in the middle of a massive global regime shift, do you have the wisdom to know exactly when to step aside?